Today's class for accounting for investments. We have in accounting for investments we have two methods, equity method and the cost method. Okay, so before we first we understand the concept of this equity and cost method and understand why we need this. So before this we should have this question should be coming our mind that our investments, how should and what cost we should recognize in our books. So if we have, like suppose if we have a shares of any Microsoft, so how much value should I recognize in my books, in my balance sheet. So to understand that, first we have to know that how much percentage if we have. Say our our accounting standard says if we have a 0 to 20% shares, then we have to use the cost method, and then cost method. And if we have of 20 to 50%, 20 to 50% which is assumed to have a significant influence, then we have to use the equity method, which is also called a one line consolidation. Okay, and if we have above more than 50% shares, then we'll do the consolidation. In today's session we'll cover the two equity and the cost method, where we'll understand the accounting entries and the concept. So suppose you are a shareholder of a company, say Microsoft, and you own say 10% of the share. Okay, so you own a share, and then in the company the board of directors actually, and the shares of the company appoints the management who runs the company. Okay, so you own a shares of a company, and the board of directors of the company appoints the management to run the company, and they declare a dividend and they own the shares. Okay, so if you are owning only a 10%, so it is assumed that 10% of the share is not having a influence of the board directors to manipulate of any dividend or to force the management to declare a dividend. So but if you have owning a 20% share, which is assumed to be having a significant influence, it means that you can influence the judgment of the management, so through the board of directors, that you can vote in favor or against if you do not declare the dividend. So if we are having a 20% share, which is assumed to be having a significant influence, then we use an equity method. Okay, so now you understand that for our investment purpose we are having a two method. One is the cost method, another one is the equity method. So if we have now first we understand the treatment of the equity method, where we are having a 20% or 20% more share, 20 to 50% share. Okay, so how the accounting entries will flow. So even if it is a equity method or a consolidation or a cost method, the first entry of any investment will remain the same: investment account debit to cash. Okay, so first thing is sorted. In every scenario, in every method, this first entry will remain the same. However, when in equity method, the difference here is like as and when the firm or the company's grows, our investment, this is the basic concept, our investment will also grow or will also increase. Okay, so so same principle, if our investment will grow, if the company income will grow, our investment will also grow. So suppose a company declares an income, then in that scenario we are having a income and our investment will grow. So we'll say that investment will be debited with the amount of the income, and then our investment will further grow, and then we'll credit the earnings in equity, which is a new GL account for all of you. So students, so this ledger account will be created for the earnings in equity. Okay, the third account is like when we receive the dividend. This is the entry when we receive the dividend. So when we receive the dividend, cash account debit to investment. Ultimately, the value of the company's earning will decrease because the company has distributed the dividend. So once the company has distributed dividend through the retained earnings, the company's values is going decrease, going to down. So we are having this, what our entry will pass will also decrease the investment. Okay, and debit the cash is the time of receive the dividend. So again, the second entry will post when the company is declaring a profit. The company declare the profit. This is when the company declare the profit. Okay, so not at the time, and when we receive, then we pass the third entry, cash account debit to investment. Okay, fourth entry is bit a tricky one. So before this, to understand, we have to understand a particular case study, we can say, where we are having a purchase value. Suppose a purchase value of a share is 1000. Okay, suppose you purchase a share in a company which is value to you is 1000, and the fair market value of the investment is 900. So it means a 900 worth of share the company gave you at 1000. So what 100 extra you paid for? You paid for the goodwill. So what is the goodwill? Goodwill is basically the value of value of any company, like the company which creates through branding. Suppose you went to a store and you find Pepsi, Cola, or local drink, but you always go for a Pepsi or for a Cola or the branded drink. The reason is the company has created a goodwill for themselves, so which force you to buy it. Okay, so hope you understand this. The higher value which you paid more than the fair value of your shares or investment is because of the goodwill. Okay, so goodwill, you understand that goodwill is amortized over a period of time. Okay, just keep in mind this concept. Now again, third one is the book value of the investment. What is the book value of the investment? The book value of the investment is the investment which a company carries in its books of accounts. So this investment is basically, you are having a one share, but this investment value is further divided into the PPE, which is property, plant and equipment. These are the separate concept we are going to read in a further coming lectures, but here we just property, plant and equipment you may understand with a concept that this is a like machinery. Okay, and the land, this could be 750, could be a land, could be a stock. So when we are passing the entry through equity method, then we consolidate as a one line in a total as an investment. Okay, but when we do the consolidation, that time we segregate it. Okay, so here the things which we have to understand here is the property, plant and equipment is basically, this property, plant and equipment is basically what we do is depreciate over the period of time. Like in a question they will mention the depreciate about 5 year or 10 year. So 5 year or 10 year, accordingly you have to amortize or depreciate it. Okay, for land doesn't depreciate. Okay, the land value is always it will not amortize, it will not depreciate. Okay, if the company is having a stock or inventory, this could be sold. Okay, so this could be sold. So what will happen, what is going to the impact of this transaction in our equity method? So you understand this part, that we are in equity method, our investment value will fluctuate, will go up and down based on the value of the company. Okay, so if the company is saying we amortize the goodwill for 1/10, say the value of the goodwill will remain 90. So 90, so the 10, it means the 100 value of the goodwill is now being depreciated, is not been amortized. So the amortized value of the goodwill is now 10. Okay, so and the depreciation here is of 15. The total value here it comes to 25, which is the which we can say is a expense or a loss. If how we will record this in our books is the expense or loss and credit to what? Asset or goodwill. Understand? So this entry how we will pass in our equity method, since we do not have asset or goodwill separately, we'll credit the investment. Okay, and debit what? Debit for till now we have introduced a new GL for you, earnings and equity in the second entry. The same way you have to debit the earnings and equity in the fourth entry. For the this is for the amortization or depreciation. Okay, hope it's clear till now. This the four entries which we supposed to pass in under the equity method, and later on we'll do the practical questions on it as well. Now what is the impact on the, just quick look on the investment GL. Investment GL is basically now we understand how the flow of the investment, as I said, purchase cost under the equity method, and the income is once the income is declared or the profit is declared, we'll pass the second entry where we'll say investment account debit to earnings in equity. Okay, so investment will further increase, and then when the dividend is declared, we'll reduce the investment will reduce. And then for the amortization and the stock sold, for the assets sold, the inventory will further reduce. Okay, so investment will further increase as the company value increase, will go down as the company value goes down, or on the basis of dividend declared, dividend paid, and the amortization of the stock. So based on the investment value, this investment account will fluctuate. On the contrary, this under the cost method, what will happen? Will record the investment, like your shares you have investment purchased in from the Microsoft or any other company, will record it at the cost, investment account debit to cash. Okay, at the value you purchase, say 1000 you purchase, so you will add entry for the 1000. Okay, what will happen when the company will declare the dividend, or company will say the income, declare the income? No entry. Under the cost method, no entry. However, under the earnings method, we have passed the entry. Dividend paid, when the company pays the dividend, then only you will pass the entry under the cash account debit to dividend, and this will further go to the income statement. Hope it's clear. Okay, it will go to the income statement. Then the fourth entry for the amortization or the stock sold. Since we are not recording this under the cost method, investment will not fluctuate, this amortization entry will not pass. Okay, so this time for amortization of stock or the stock sold, no entry. Okay, just quick look on the investment account. So for the purchase cost value, in income no entry, dividend no entry, amortization of stock no entry. So investment will be appearing at the cost value. Hope students this cost and equity method is clear to you. Okay, so this time we have explained the concept of the equity method. Quickly we just go to the PPT prepared for just to brief the presentation. Okay, just waiting for. Okay, so in this also we have described all the understanding the investment value. Okay, so in this, okay, just quickly understanding the investment accounting. The two methods is basically, we said, the cost method and the equity method. As we clearly mentioned, 0 to 20% the cost investment has to be recorded at cost. For 20 to 50% it will be the equity method, or we call it one line consolidation method. In the today's lecture we covered these two method only. The above 50% and above consolidation, where we get the control, means like the control is quite a big thing, where we consolidate and we call it parent and subsidiary, or the acquirer and acquiree. However, for the cost and equity method, we call it investor and the investee. Okay. The cost method and the fair value through cost method is basically fair value through net income. Okay, so where we use, so we have explained this in our lecture, in our presentation already. So the entries, we explained it already in the detail. The equity method, we understood that it is 20% and 50%. Accounting treatment, we have seen through the entries. Okay, and entries, we have seen that initial investment, the cash investment. Second entry, we have seen when the share of net income is investment in investing, can it credit to equity in earnings in equity or equity in earnings. Okay, and the cash, and when the dividend is received, cash account debit to investment account. Okay, here there is one more entry which I have already shown you, where we have like for earnings in equity, debit to investment, and this entry is for amortization of goodwill or depreciation. Okay, so this is the fourth entry. Next is we are given the practical question as well. The difference is like less than 20% the cost method, equity method 20-50% influence, there is no significant influence. Equity method is having a significant influence. Dividend, we say income, and this dividend reduces the investment. We have already seen while preparing the lecture. Hope this helps students. Thank you. We will cover up the next in the coming session.